Hey traders, Mike Sir here. Welcome back to part 2 of the 4-part video series where I teach you how to make money from trading cryptocurrencies. Now in part 1, I introduced you guys to the world of derivative trading and the various types of crypto derivatives that you can trade. Also, I talked about the benefits and risk of trading crypto derivatives. Now, if you haven't watched part 1 yet, please watch that video first as it will give you a good overall understanding of how these trading instruments work. So in part 2, I'm going to dive a little bit deeper and show you how to make money with Bitcoin futures, the most popular crypto trading instrument. Also, I'll share with you a simple strategy that I use to make money in Bitcoin futures. So let's get started. As I mentioned in part 1, Bitcoin futures contracts are financial contracts that obligate the parties to transact Bitcoin at a predetermined future date and price. Now, the buyer of the contract must purchase Bitcoin at the set price at the expiration date. Now, the seller must sell Bitcoin at the set price at the expiration date. Now, let me give you an example. Let's say today in March 2022, you believe that the price of Bitcoin will rise in value to $100,000 by the end of December 2022, and you want to profit based on this belief. So what you want to do in this case is enter into agreement today to buy 1 Bitcoin to be delivered by the last Friday of December 2022. The price of the December contract will generally be a little bit higher than today's market price of, let's say, $40,000 per Bitcoin to account for the future delivery premium of the contract. But if the Bitcoin prices rises in value before the end of 2022, then you'll be able to buy Bitcoin below market value and thus profit from this contract. In addition, as I mentioned, one of the benefits of trading Bitcoin futures contracts is the ability to profit when Bitcoin prices fall. Now, with the actual Bitcoin itself, there's no way for you to profit on the downside. You only make money when the price of Bitcoin goes up in value. So let me show you an example of how you can profit when Bitcoin prices go down. Again, let's just say today in March 2022, when Bitcoin prices are around $40,000, you believe that the price of Bitcoin will fall in value to $20,000 by the end of December 2022, and you want to profit based on this belief. Well, what you want to do in this case is enter into agreement today to sell 1 Bitcoin at a fixed price as determined by the December futures price and deliver 1 Bitcoin by the last Friday of December 2022. Now, if the Bitcoin price falls in value before the end of 2022, then you would be able to deliver the Bitcoin to the buyer at a lower market value and thus profit from this contract. So this type of derivative trading is suitable for speculators who want to bet on the upside or downside of the value of Bitcoin. In addition, as I mentioned in part 1, you can choose to trade perpetual contracts, which are very similar to futures contracts, but they don't have an expiration date. Before I share more specifics of each Bitcoin futures contract, I just want to let you guys know that this video series is sponsored by Delta Exchange. Now, they built one of the most liquid and trusted global currency derivative exchanges and are run by the founders who bring expertise across financial markets, derivative trading, product and engineering from companies including Citigroup, UBS, and Hotstar. Now, they're well financed by investors such as AAVE, Coin Fund, and Kyber Network. They have an incredibly comprehensive product offering with more than 100 crypto derivatives to choose from and are number 2 in crypto options trading volume globally. Now, they're currently offering a special promotion for only my viewers. So if you sign up for an account today, you'll receive a 10% discount off any trading fees. In addition, try options trading on the Delta Markets platform and get up to $100 cash back on your first options purchase. Please click on the link in the description box below to sign up for an account and start trading today. Okay, back to the video. First off, I want to be clear that buying a Bitcoin futures contract doesn't mean that you own Bitcoin, but rather it gives you an exposure to the Bitcoin price. The actual futures contracts settle financially in cash on the delivery date, meaning that if you buy a Bitcoin futures contract that expires by the end of December, you don't physically receive Bitcoins by that time. Now, no Bitcoin actually changes hands between the buyers or sellers. As in other commodity futures contracts like gold or oil, you are essentially speculating on the price of Bitcoin and not buying or selling Bitcoins. Now, it's the same for oil. You're not physically going to receive a barrel of crude oil when you buy an oil futures contract. You don't need to have a crypto wallet to store your coins, as there are no coins transferred to you. So if the buyer or seller of a Bitcoin futures contracts holds an existing position and shows a profit on the delivery date, then the difference between the purchase price and the settlement price is paid out to the holder of the futures contracts in their crypto derivative account. Now, if the position shows a loss, then the difference will be taken from the holder's account. Okay, now that you're clear, let me answer the common questions that you might have about trading Bitcoin futures and their specifications. One question that you might have is, what are you buying and selling? So when you buy one Bitcoin futures contract, you're buying one Bitcoin in US dollars. Now, some exchanges offer you to buy one Bitcoin in USDT token, which is Tether. And this USDT token is another cryptocurrency, which is backed by the equivalent amount of US dollars, making it a stable coin with a price pegged to $1 US. Now, there's no difference between buying a Bitcoin futures contract priced in USD or in USDT. Another question that you might have is, how much money do you need? Now, since you're buying a derivative contract, you are essentially margin trading, which means that you're only required to put a minimal percentage of a contract's total value in order to trade it. Now, in terms of delta exchange, you're only required to put 1% of a Bitcoin's total contract value to trade a Bitcoin futures contract. Now, this is equivalent to giving you, the trader, 100 times leverage. Another question is, what is the listing cycle? Now, the listing cycle for Bitcoin futures contract is a quarterly cycle consisting of March, June, September, and December month contracts. Another question is, what are the trading times? Now, the trading times for Bitcoin futures are from Sunday, 6 p.m. Eastern Standard Time to Friday, 5 p.m. Eastern Standard Time. Now, there is a 1 hour break between 5 p.m. Eastern Standard Time till 6 p.m. Eastern Standard Time each day, unlike the actual Bitcoin, which trades 24 hours a day, 7 days a week. The last question that you might have is, well, what are the trading fees? Well, Bitcoin futures traders will encounter two types of trading fees. Now, the most common type is called taker fees, which are incurred when traders remove liquidity from the order book by placing market orders. Now, most traders incur these fees when they want to buy and sell futures contracts immediately rather than wait for the price to reach their target entry or exit target price. However, the other is called a maker fee that the exchange pays traders when traders add liquidity to the order book by placing a limit order below or above the market price. Now, the purpose of the maker fee payment is to encourage market participants to increase the size of the order book so prices can be more liquid. Now, generally, maker fees are referred to as payment for order flow on the Bitcoin futures exchange, so therefore it's in your best interest to be a maker rather than a taker. Here you can see that the maker fees are lower than the taker fees on the Delta exchange. Besides traders who want to speculate on the future price direction of Bitcoin, there are hedgers who already own Bitcoin or mine Bitcoin, but want to protect themselves against the decrease in value of their Bitcoin holdings. Now, hedging is a way to reduce the risk of holding Bitcoin given the high volatility of cryptocurrencies. Now, let me show you an example on how a hedger would trade Bitcoin futures. So let's just say that you own 2 Bitcoins at a value of $60,000 each, totaling $120,000. Now, you believe in Bitcoin in being an inflation hedge, which is the reason why you bought it in the first place. But you can't stand the wild price swings in Bitcoin. So to minimize the risk of your Bitcoin position, you would enter into a futures contract to sell 1 Bitcoin for $60,000. Now, if the Bitcoin price falls, you minimize the downside risk as you would make a profit on the selling of the Bitcoin futures contract. But if the Bitcoin prices rise, you profit on the increase in value of your 2 Bitcoins. Also, there are hedgers who hedge 100% of their entire Bitcoin positions portfolio when Bitcoin prices fluctuate wildly by selling an equivalent number of Bitcoin futures contracts equivalent to the number of Bitcoins that they own. Then, once Bitcoin prices stabilize and resume their uptrend, the hedgers would exit their Bitcoin futures positions. Before I share with you the trading strategy and an example of how I trade Bitcoin futures, please take a moment to like this video, hit the subscribe button if you haven't already, and tap on the notification bell. You'll be alerted when the next video comes out for this 4-part video course series on how to make money from trading cryptocurrencies. Here's a chart of Bitcoin versus the US dollar. Now, the simple trading strategy that I like to play with Bitcoin is called breakouts. Now, I like to wait for the Bitcoin price to stabilize or go sideways for a while. Now, it could be a few days or sometimes a few weeks, but once the price has established a narrow price range, then if I believe that the price can go higher, then I would place a buy stop order a little bit above the price resistance level. And you can see from this chart that there is a price resistance level around 40,000. So what I would do is place a buy stop order around $40,000 100. Then I would place a stop loss order below the now support line around 39,900. So basically I'm risking $200 per Bitcoin here. Now you can see that I put a pretty tight stop loss of $200, and because Bitcoin prices can be very volatile, I could get stopped out and lose $200 pretty quickly. However, this is a strategy that I use to play Bitcoin futures, as you can't set too wide of a stop loss. Now, you expect it to get stopped out 2 to 3 times at the same price level, which is why you pre-plan your risk ahead of time. So for example, if you just don't want to lose more than $200 per trade, then don't buy 1 Bitcoin. Just buy 0.5 Bitcoins and allow yourself to try 2 times. And if it doesn't work 2 times, then you stop trading. But in this case, the price did go straight up and reached 45,000. So in this scenario, let's say you bought 1 Bitcoin and what you did is risk $200 to make $4,900. A very good risk to reward ratio of 24.5 to 1. In addition, because the Bitcoin futures contracts only requires 1% margin, you only need $401 of your capital to make over $4,900 in profits, and over 1,221% or 12 times your return on your capital. And this is the power of trading Bitcoin futures contracts. Thanks for watching part 2 of the 4-part video series of how to trade Bitcoin futures. Part 3 will be released next week. Please make sure you hit the subscribe button and the notification bell so you'll be alerted when the next video will be released. I'll see you all in the next video.